Hi, this is Shamsi. I'm a finance professor and welcome to another video. So today we are going to talk about the second part of the introduction on strategic business analysis, and this time we're going to be diving into the valuation of businesses through their financial statements. So last time we spoke about what business analysis is, who is the business analyst, and why do we need to do business analysis in the first place. We established that business analysis is something that we need to do in order to make sure that the business gets to its destination, and for the business to be able to identify new opportunities, the avoidance of costs, and understanding better the required capabilities and modeling the organization in the way the stakeholders and the management would like it to be. So, in short, in the last video, we concluded that business analysis helps businesses do better. So now that we've established that part, let's start looking into the different sides of business analysis. And one of the more important sides, or rather one of the sides where people are really interested in looking at, is a business's financial state. So it is important that in business analysis, we get to also learn how to analyze the finances, because businesses and finances are two of the things that majority of the stakeholders are concerned about. So before we dive into any financials, let's review the role of financial reporting in capital markets. So here in this diagram, we see how money flows within the capital markets. According to this diagram here, people who have savings will go to financial intermediaries, or therefore the providers of funds, or therefore the people who have excess cash and are willing to lend that money will go to a financial intermediary. And these financial intermediaries will find people or businesses who have business ideas that they would like to implement if they had the money. So from this business idea, as it evolves, it produces information and flows through information intermediaries that affect their investment decisions. Thus, it just goes to show that in finance and in business, one is the cause of another. So as you can see here in the diagram, the capital markets is the bigger square, and within that capital markets, there are regulatory agencies that regulate transactions done by financial intermediaries, as well as third third-party checkers of information that is being provided to the savers / investors / the providers of funds. And these providers of funds will work through the financial intermediaries to find and make money out of the need of the businesses or the people who have business ideas, or as you call it in the financial market, the users of funds. A critical challenge for any economy is the allocation of savings and the transformation into passive income. Therefore, the creation of investment opportunities. Economies that do this well can exploit new business ideas, spur innovation, create jobs, and wealth at a rapid pace. So as you can see from the chart, it's just a cycle. And this cycle actually affects the movement and the growth of the economy. In contrast, economies that manage this process poorly tend to dissipate their wealth and fail to support business opportunities. So, as a recap in your financial markets concepts, savings in an economy are widely distributed among households. These are usually your average Joe, the average workers who have excess money that they want to put elsewhere for the rainy days. On the other hand, there are usually many new entrepreneurs and existing companies that would like to attract these providers of funds for their business ideas. While both the providers of the funds and the entrepreneurs would like to do business with each other, matching the amount of savings to the business opportunity present becomes complicated. Because firstly, entrepreneurs or those who have business ideas have typically better information than those that, or compared to those who are providing the funds. When we take a look at this, communication by entrepreneurs to investors is not completely credible, because investors know entrepreneurs have an incentive rather to inflate the value of their ideas. And thirdly, savers generally lack the financial sophistication needed to analyze and differentiate among the various business opportunities. Now, the presence of these complications lead to what the economists call as lemons, which potentially are the fall or can become the fall of a well-functioning financial markets. So, as you can see here in the chart, to prevent the failure of the capital markets, there should be regulatory agencies in place. And there should be institutions that enhance the credibility of information being put out there. Therefore, there should be a presence of auditors and the audit committee. There should be the presence of financial analysts and credit rating agencies and financial press. Now, to ensure that the providers of funds and the users of funds are able to find one another, there should be a third party intermediary that would link them together, though they are working with one another indirectly. So, who are these financial intermediaries? So, these are the venture capital firms and private equity firms, the banks, the mutual funds, and the insurance companies. Now, given that it is the situation or it is the cycle that happens within the capital markets, it is the financial reports that bind them all together. How? Let's take a look. Information intermediaries attempt to add value by enhancing the credibility of financial reports or by analyzing the information in the financial reports. So information intermediaries boost the reputation and the credibility of a business by checking and ensuring that the financial reports are free from material misstatement, and by interpreting the information found in the financial reports in such a way that more people are able to understand what the report contains. Second, financial intermediaries rely on the financial reports to analyze investment opportunities as supplemented by information from other sources. So, of course, financial intermediaries also need the financial report to check whether a business is presenting a good and a profitable business opportunities. And of course, they will also use the information found in the financial reports to corroborate it with information received from other sources. Third, the financial reports are subject to the regulatory policies and legal framework as promulgated by agencies such as the SEC, or in our case, the International Accounting Standards Board, or in the Philippine setting, this is the Philippine Financial Reporting Standards Council. So, lastly, we need to remember that the financial reports draws the picture and shows us the economic consequences of any business's activity. All right? So, if you take a look at this, the financial reports is the element that would address or that is in the middle of this framework. Now, why do we need to go through all that preface? Because we need to understand that our financial reports is influenced by an accounting system. And an accounting system affects the quality of information being found in the financial statement. So here's a chart that shows us what the financial statements contain and the different elements that dictate how the financial statements would be affected. So as an accountant, I'm always taught to follow the accounting standards. But in terms of business analysis, we must take a look at this from a different angle. Because in business analysis, we are trying to diagnose a business problem. And it is quite plausible that the source of the business problem is not the processes, but probably the quality of information our investors are getting because of certain policies, certain business strategies, certain activities, and the business's environment as a whole. So, studying the effect of our accounting system and how it affects our information quality is vital in this case. So let's take a look at that. So one of the influencing factors of information quality in terms of accounting is first the accrual basis. So the accrual basis, accrual basis of accounting rather, basically states that an income rather is recorded when it is earned, and expense is also recorded when it is incurred, regardless when the income is received or the expense is paid. So, in accrual accounting, costs and benefits are recorded in association with economic activities. So that's what I just said earlier. Accrual accounting follows the matching principle, where income earned during the period should have a matching expenses that is also recorded in the same period. Therefore, net income is computed on the basis of expected receipts and expenses. Because, as what I have said earlier, accrual accounting or the accrual basis actually hinges on the fact that if you have earned a certain income, then you can now recognize it on your financial statements. The same way is true for your expenses. If you've already used up that particular expense, regardless of whether it is paid or unpaid, you should be able, or you should rather, be able to recognize it on the face of your financial statement and deduct it from your income. So, the need to report on accrual basis arose from the investors' demand for financial reports on a periodic basis. So, this is why accrual accounting was developed, because there was clamor from investors to know if the business is doing well. And how do they measure that? Through the financial reports. So, with that said, we need to remember that the financial intermediaries using the financial statement data to do their respective business analysis have to be aware that financial reports are influenced both by the by the firm's business activities and by its accounting system. So therefore, the key aspect of financial statement analysis should therefore involve a thorough understanding of the influence of the accounting system and its effect on the quality of the financial statement data that is being used in the FS. The institutional features of accounting systems that has been instilled by us as accounting students are factors that determine the extent of the influence that it has on the information that we get. And one of these features is actually accrual accounting. Okay. Second, aside from accrual accounting, there is also the presence of accounting policies and procedures. We have been taught as accountants that we should be able to establish accounting policies and procedures, and therefore we should be able to follow it consistently year after year. That would actually result to a more consistent, a more comparable set of financial statements. However, accrual accounting is subjective and relies on a variety of assumptions. So when we do accrual accounting, we follow certain policies and procedures. And these policies and procedures may be different from one company rather over the other. The numbers in financial reports can be subject to manipulation by management because the accounting policies and procedures will reflect or will affect rather than the amounts that are shown on the face of the financial statements. And because management is responsible in choosing the accounting policies and procedures that they are going to adopt, they will, to some extent, be able to manipulate the information that they show on the FS. So, a variety of acceptable accounting policies have evolved to give flexibility depending on the firm's environment. As we know, accounting is very procedural and it is very by the book. So, as the practice of accounting evolves, our rules have also changed depending on the environment that our business is in. So, because accounting, like I said, is very procedural and is very by the book, the uniformity, the consistency, and the comparability actually reduces management flexibility to reflect business differences in their firm's financial statement. Precisely because they have to follow certain reportorial requirements. So, for example, the numbers that we see on the revenue line may not tell the entire story because on the revenue line in the income statement, all we see are numbers. And if we read through the disclosures found in the notes to financial statements, all we see are the salient information or the salient points that would be needed to know by the investors and the public. However, since there is a certain degree of rigidity in the accounting process. Therefore, the company does not really reflect the true nature of the business, or does not show really how the business operates or how it differs from other businesses in the same industry. You will not be able to see that on the firm's financial statement. Where do you see that? You would see that if you dig a little deeper in your business research, in your industry analysis, and in aligning your strategy to the goals of the corporation or the business where you are affiliated with. Feature number 3 is manager's reporting strategy. So accounting systems in the real world leave considerable room for management to influence financial data. And accounting regulations only prescribe the minimum disclosure requirements but do not restrict management from providing voluntary additional disclosures. So, as was said earlier, the management is responsible for choosing the accounting policies and procedures that is going to be adopted by the company. Therefore, they have the power to some extent to influence the financial data through their decisions. In accounting, you don't really see a full list of what companies need to report. Instead, what you see are the minimum disclosures. So, it would still depend on the business if they would like to provide additional disclosures on top of what is required as base information that would have to be provided to the users of the financial statements. In the notes to financial statements, you won't see multiple pages of disclosures about a specific account. Usually, you would see a disclosure for a specific account condensed in 1 to 2 paragraphs, but never like a novel. So, accounting basically states that if you have a certain transaction in your annual report or in your financial statement, then you must at least present the following. But it is up to the management if they are willingly or if they think that additional disclosures would be necessary. So, third, managers can also use financial statements to provide more information useful to investors in assessing their firms true economic performance. So, as we know, financial statements are like the phones for businesses. Through the release of a company's financial statements, the company is actually communicating with investors. So, given that the financial reports are a point of communication, or in this case, a conversation starter among investors, therefore, the managers can use the financial statements to provide information that they believe investors will find useful in the assessment of their firm's true economic performance. So much like when we talk to people that we don't trust, it's only in a need-to-know basis. If it's not something the other person you believe shouldn't know, then you won't tell them, right? So in this case, the financial statements contain information that the management would really like to convey the investors. But in some cases, the management would like to only show the good, not so much of the bad, and definitely not the worst. While the financial statements are said to be unbiased and faithfully represented, regardless of whether the company gets the short end of the stick or not. It should be able, or managers should still be able to provide information to the investor. So depending on what the management would like to send out to the investors, it would be reflected as an item or as a financial statement, and it will be distributed and cascaded to the public. And with that said, therefore, the managers actually use financial reports to manipulate investors' perception. Because imagine this, if you are able to control your image with the public, won't you at least try to ensure that what the public sees or hears about your business is nothing but good things? Syempre, hindi ka naman magbo-broadcast kung pangit ang balita, correct? The last feature is auditing. So let's recap. What is audit? So audit is the verification of integrity of the reported financial statements by an external party. So audit actually improves the quality of accounting data. Audit by an external party may also reduce the quality of financial statement because it constrains the kind of accounting rules and conventions that evolve over time. So what does this mean? It means that because auditors actually check for the integrity of the financial statements, sometimes what the auditor sees to be the appropriate rules and conventions, they might be limiting the way the financial information is presented because they want to follow the rules. The legal environment in which accounting disputes between the management, auditors, and investors are adjudicated can have a significant effect on the quality of the reported numbers. So let's see who has accountability for the financial statements. The accountability for the financial statements fall on the management, right? So if that's the case, then the management should be able or should be accountable to investors because the investors will rely on what the company reports through their financial statements. And added reliance or less reliance will be done by the investors depending on the quality of information presented as verified by the auditors. That is why it is necessary for a business to find an independent or to establish an independent audit committee that will serve to enhance the quality and the accountability of financial information. Because in the current setup, an audit committee or an independent audit committee does not report to the CFO, does not report to the head of BizDev, nor do they report to the operations chief, but they report directly to the president of the company to maintain their independence and to limit undue influence. All right. Next, we're still in auditing. So in terms of auditing, there are some legislation that affects financial reporting and auditing. So in the US, there are two major pieces of legislation that made important changes in financial reporting and auditing. So these two laws are the Sarbanes-Oxley Act of 2002 and the DoddFrank Wall Street Reform and Consumer Protection Act of 2010. So let's take a look at what Sarbanes-Oxley or SOX says. So, SOX mandated certain fundamental changes to corporate governance as related to financial reporting and altered the relationship between a firm and its auditor. So here are some of the highlights of the SOX. So the SOX gave birth to the creation of the Public Company Accounting Oversight Board. And their job is to ensure that standards for auditing and the ethics and independence of public accounting firms. So PCAOB is present to police and uphold the ethical and the ethical work and the independence of public accounting firms. So when we speak of independence, we are talking about the independence of mind, meaning the auditors should be free from undue influence from their clients, and independence in fact, meaning they are not in any way related to a particular client. The SOX also mandated stricter guidelines for the composition and role of the audit committee of the board of directors, including a director that is independent and should have financial expertise. So, as you can see, it is only through the SOX that the presence of a director who has independence and financial expertise was upheld. Before the SOX, you can actually build an audit committee without having someone who has financial expertise. Third, the SOX enhanced the corporate responsibility for financial reporting by requiring the CEO and CFO to personally certify the appropriateness of periodic reports. So, in the Philippine setting, our financial reports is signed by the CEO and the CFO also. And we have to specifically and explicitly state that the management of the firm and not the auditors are responsible and accountable for the financial statements. So, why did the world or why did the US create SOX? SOX was created because the tech bubble of the early 2000s or the late 1990s has collapsed. And there had been accounting standards such as Enron and WorldCom that tainted the accounting profession. Because of the shady nature of these scandals that involved certain audit firms, the U.S. Congress passed the Sarbanes-Oxley Act to protect not just the public, but also the businesses from shady activities and shoddy work, if I may say so myself. Furthermore, SOX required management to assess and report on the adequacy of internal controls, which then needs to be certified by the auditor. So, there should also be a check on the internal controls, which would be reported upon by the auditor. Second, because of the scandals that was Enron and WorldCom, SOX also provided greater protection for whistleblowers. Third, allowing for the imposition of stiffer penalties, including prison terms and fines for securities fraud. If in the past, these types of offenses were not taken seriously in the US, they made sure that through SOX, these kinds of infractions would no longer happen. That is why they heightened the sanctions that would be imposed if in case there is any securities fraud. Number 4, prohibiting accounting firms from providing certain non-audit services. So, SOX actually dictates what accounting firms can provide in terms of services, especially when these services are happening at the same time as an audit, and they also mandate audit partner rotation to prevent advocacy for a certain business. This is the reason why auditors are being reshuffled every now and then, because they are trying to maintain their independence from the clients, and they do not want the audit team to get to a point where instead they would do their jobs objectively. They would instead advocate for the client. Last 2 points about Sarbanes-Oxley Act actually shows us that the Sarbanes-Oxley Act prescribed conflict of interest rules for equity research analysts and increased the funding available to the SEC to ensure compliance. All right? So, it is through Sarbanes-Oxley Act that the US SEC had more power and they had more scope because they are the authority that governs corporations. And because of what happened with Enron and WorldCom, they have to make sure that they are the powers that be and correct and appropriate sanctions would be imposed immediately. All right, now that we know about SOX, let's go to the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. The Dodd-Frank Act was passed in 2010 in response to the financial crisis on the Wall Street. So if you've watched The Big Short, then you would relate that happening to the Dodd-Frank Act. The new legislation mandated important new changes in the governance of banks, including the following: the creation of a new independent consumer protection agency that ensures consumers receive the information they need to shop for financial products. Second, the act actually increased the monitoring of banks, including restrictions on proprietary trading. Third, new procedures to facilitate the orderly liquidation of failed banks. And number 4, increased transparency of the trading of financial instruments, which should facilitate fair value accounting for these instruments. So, as you can see, the Dodd-Frank Act did not just impose stricter requirements for banks, but as well as a change in the accounting methods for financial instruments that are being traded in the financial markets and the capital markets. Also, the act was actually the proponent for the increased oversight of ratings agencies. Second, the act also provided shareholders a non-binding vote on executive compensation and increased disclosures on the assets that underlie complex financial securities. So the Dodd-Frank Act was created because of the collapse of the financial market in 2010. So this was around the time when Lehman Brothers, AIG, I believe, was one of the financial institutions that collapsed at this point. So the Dodd-Frank Act was to ensure that this never happens again, because in 2010, when the major financial institutions crashed and went belly up. The whole world actually felt it. Now, to end our discussion of Module 1, here's a question that I would like you to think about. After discussing the SOX and the Dodd-Wall Act of 2010, in the Philippines, do we have these equivalent laws? So I invite you to keep reading on the next few slides to find out. And I will see you in the next one. Thank you for listening. I look forward to seeing you in our next video. Bye.